Hello, traders, and welcome back to the Forex Geek, where we dive deep into the tools that can help you make smarter trading decisions. In today's video, we're going to explore the EMA Breakout strategy, which is a method designed to help you identify market trends and potential breakouts with precision. Stay with me until the end as I guide you step by step through how to apply the strategy effectively and avoid common mistakes that could undermine your trades. So, without wasting any much of your time, let's get started. First of all, I will add the moving average exponential indicator to our charts. So this is the EMA, and unlike the simple moving average, the exponential moving average gives equal weight to all price data. It is a technical indicator that reacts quickly to price changes, as you can see. This makes it a useful tool for identifying shifts in momentum and spotting potential breakout opportunities in the market. A breakout happens when the price moves decisively above or below a key level, signaling the start of a new trend. So, the EMA helps you identify these moments by highlighting when momentum is building in one direction. For example, when the price closes above an EMA with strong volume, it often indicates that buyers are stepping in and pushing the market higher. Similarly, a close below the EMA could signal that sellers are gaining control. And you can use different EMA periods depending on your trading style. Shorter EMAs like the 20 period EMAs are great for capturing quick moves. So just gonna add the 20 period EMA here. There's the 20 period EMA, and you can also use longer day EMAs just like the 50 or 200 period EMAs. These are also good for identifying long-term trends. So I'm just gonna include the 50 period EMA. That is my longer period EMA, and it's going to be red in color. Okay, we have it on the charts. Now, combining multiple EMAs on your chart can give you a clearer picture of market direction. For instance, if a shorter EMA crosses above a longer one, it's often seen as a confirmation of an uptrend, and vice versa. If it crosses below it, it's for a downtrend. Just crossing happening here, have the crossing happening here for bullish trend, and there is a bit of range. This is a ranging market, so it's advisable not to trade during these ranging markets, but wait for when the market is giving clear signals. So volume plays an important role in this strategy. A breakout is more reliable when accompanied by higher than average volume because it shows that there is strong participation behind the move. So I'm just going to add the volume indicator also, and this is the volume. So when you see a breakout happening in price, it could be the price moving above the moving averages. You should watch out for accompanying volume. You can see this breakout here, and you can see the accompanying volume following this breakout. It means that this breakout is a valid one. Without volume confirmation, breakouts can be false signals that quickly reverse. For example, let me look for an example where we had a crossover, but it wasn't worthwhile. Okay, you can see this crossover happening right here. There's a cross here signaling that we could be switching from bullish to bearish, and at the same time we can't see any increasing volume spike here, showing that this could just be a fake out or a false signal. So always watch out for those volume confirmations, they are very important. So let's just approach this strategy step by step. The very first step is to include your moving averages, insert your moving averages to your chart, the 20 period EMAs for your shorter moving average, and the 50 period or 200 period moving average for your longer moving average. And the next thing after inserting your indicator, your EMAs, is to watch out for trend shifts and breakouts. Now, when we talk about breakouts, we're talking about price moving above both EMAs and also looking out for crossovers at the same time. We have price breaking out of this from below the EMA to above the EMA. This is the breakout. So that's what we call the EMA breakout. This is the EMA breakout strategy we're talking about. And price breaking from below to above signals the EMA breakout. So we should be looking for ways to enter this market. Then the next step is to also watch out for increasing volume. The volume confirmation here is very important. Watch out for increasing volume in the market to confirm your breakouts before entering your trades. So let's look out for another wonderful example which we can use. Now you see this breakout happening right here. Price went briefly above both EMAs before giving us this breakout. And at the same time, you can see the volume supporting it. Have the volume here, supporting this breakout, and price use the 50 period moving average as dynamic resistance level before pushing all the way down. Now you can see two things happen here. We have the breakout from above the EMAs to below it, confirming a bearish trend, and we have the volume confirming that yes, this is a valid breakout and we should be looking to actually sell or short the market. You can see that we actually had a crossover here and a breakout to the upside, but we didn't have any significant volume spike here. So that shows that we shouldn't be looking to take any buy trades. We should always wait for the volume to confirm our breakouts before taking any trades. You can see we had a breakout happening here. At the same time, we had that cross, and you can see increasing selling volume and momentum growing in the markets here. You can see the spikes. So this shows that yes, we should look to sell. If volume is low during a breakout, it could be a false signal that reverses quickly. So always look out for volume spikes to validate your entry. Always remember to also manage your trades. After spotting the volume, you can look for significant candlestick patterns like this to take your entries off. Just stop loss above that candlestick pattern's high. This is a bearish engulfing candlestick pattern, and manage your trades. You could target significant support levels like this one, or you could just target a fixed risk reward ratio of 1:2 or 1:3, whichever one suits you and your strategy. It's all welcome. And you can also use for your stop loss, you can also trail your stop loss. You can use your trailing stop loss orders to lock in gains as the trend develops further. You can see price following this 50 period moving average, so you can just use this 50 period moving average to trail your stop loss all the way down to capture all the gains as price moves all the way down. So this approach allows you to stay in winning trades while protecting your capital. So common mistakes to avoid is that you shouldn't over rely on the EMAs as your sole entries. Always make sure you incorporate volume. Always make sure you incorporate volume. Don't just trade blindly when you see the crossovers and when you see the breakouts. Always use volume to validate your breakouts and ensure that there's a spike in those breakouts before placing any trades. So also ignoring risk management is another mistake that can be costly. When you see a trade, you should always apply your risk management, never risk more than 2% of your trading account so that you won't end up blowing your account and having to start all over. Over leveraging your positions is also another mistake. Adjust your trade size based on market volatility and your account balance to avoid taking on more risk than you can handle. This ensures you stay in control even during unexpected market moves. So that's how you can use the EMA breakout strategy in your trades. Alright, traders, you've come to the end of the video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, don't forget to like, subscribe, and turn on the notification bell so you never miss out on more trading tips and strategies. Thanks for watching, and I'll see you in the next video.